We could leave that on.
It's up to you.
You have on.
13.
That seems light. I know they are doing watch parties at a couple of the offices though. So like Fresno
Fresno's.
probably has 20, 30 people there. So, okay.
That's the only group, so probably 20, at least 20.
Yeah. Okay. And what time is it on your end? Okay.
Yeah, I don't want to get out of this.
Yeah, that's what my watch. Okay. Because I just reset this watch for the time. I want to make sure I didn't like set it wrong. So no one having to go and reset all your clocks and watches. So hopefully this time change thing's done. Fine. We'll see. You're not really.
Good.
I'm still adjusting that time change. Last 2 mornings I had trouble like waking up. So I'm so used to waking up at the same time every morning. Now it's like an hour earlier.
Recording in progress.
Probably early recording. Muted. Gonna go.
We're muted recording.
Okay. Let's go ahead and get started then if you want to unmute.
It's already got muted.
Okay. All right. Good morning, everybody. Thank you for coming today in person here in Visalia and virtually out at the branch offices today. Got a lot of information to go over with you guys. Hopefully, many of you had a chance to read the report that I sent out about a month ago. And it's going to be all about that today, plus more and some additional insights based on how we're trending in the market so far this year. But we're talking about a lot of numbers. I know sometimes numbers are daunting and overwhelming, but we're recording this presentation. We've got notes. If you have any questions, what we'll do is we'll reserve the questions for the end of the meeting, and you'll be able to put them in the chat, and or if you raise your hand at the end during the Q&A session, Kevin here will unmute you and you'll be able to ask questions. But if you could please hold all questions, just write them down somewhere until the end of the presentation, just so we can stay fluid on it and get you guys out by 2 p.m. today. No, we're going to try to get you guys out by noon today because I know we're getting, people get hangry, they want to get to lunch. So we're trying to keep this at 60 minutes or less. So this is the 2025 annual report presentation. The tagline this year was, or is, reshaping the future of real estate. And so what do we mean by that? Well, there's been a lot of change over the last year, right? We went through some monumental changes, more specifically with the NAR settlement, which we'll talk about a little bit more. But in general, we had to redefine how we do business, how we communicate with buyers and sellers, and how we seek compensation. There's a lot of things that are changing and evolving in the market. The market dynamics were very interesting last year, and they continue to be interesting, but interesting in a more optimistic way, which I'll share. But look, we control the narrative. I've always said that. We as realtors and real estate professionals control the narrative in the market, and we need to be out preaching the correct narrative. It is a great time to buy or sell real estate. I'm going to prove that to you. There's no reason to wait. There's no reason to wait. We need to get people in the mode to do it now. So, all right, let's dig in here and see what we got. Don't wait to buy real estate and wait. What I just said, Mr. T. Harv Eker. Anybody read The Millionaire Mindset, the book that he wrote? Pretty good book, check it out. But he's absolutely right. Why do we wait? What has real estate done since the dawn of time when they made houses out of rock? It's only gone up in value, right? we've seen that. There's only been a couple blips over the last century where values have gone backwards dramatically. The Great Recession was one of them. That was a very unique market that we may never see again because it was all driven by phony, lending and bad lending practices. And that caused what happened to happen. But over time, it does nothing but go up. All right, today we are going to cover a brief introduction reflecting on what happened in 2024, our company's strategic response to what happened, and then the 2025 market forecast, why consumers should act now with a very compelling graph that you guys can have access to. You should have had it in the printed report that we put out. And 2024, 5 bold predictions that did I hit or miss? Remember I put out 5 for last year? We'll see how I did on the report card here. 2025 bold predictions and closing thoughts. And then we will reserve all questions to the end. All right, relax. My broker says the market will come back. I am your broker. Work for food. Right? It seems to resonate a little bit. And it hasn't gotten that bad, by the way. If you go on my LinkedIn, I don't know if anyone's been on my LinkedIn, it does say open to work up in my picture when people are seeking jobs. And that's the truth. I'm not joking about that. But just for clarification, I'm looking for speaking opportunities and training opportunities tied to my book. So it's not that I'm looking for a job, just in case somebody pops out there and goes, okay, I saw that cartoon, let me check. This guy is really looking for work. All right, we're okay. All right, reflecting on 2024. So what really happened? Well, number one, we're glad it's over, right? In a lot of many different ways. In spite of that, some of you did very, very well. You were relentless and you continue to do well because you showed up every day. You really grinded day in, day out. You didn't let the market dynamics really depress you and hold you back. And really congratulations to those people that had decent years last year, and many of you did. And you got through it, and real estate still sold. And I'm going to show you it did better than we thought it would. But I think the consensus is we're glad that it's over. This is an interesting graph that I created. Well, actually, ChatGPT created this. I'm not that good, but Chat does a pretty good job. But what I asked it to do is I wanted it to show me the national single-family residential home sales over the since 1990, and wanted to see how it fluctuated during that time period. And if you look at it, it's pretty interesting that last year, which is over on the right of the slide, we ended up slightly over 4 million sales nationwide. I think it was 4,060,000 sales or something like that. And that is the lowest unit volume that we've seen in single family home sales since 1995. That's how bad it got on the unit volume side. So it's interesting. I'd heard that somewhere. I went and researched, okay, sure enough, that's the case. We peaked in 2005 where we crested over 7 million nationwide. Well, what was going on in 2005 is some of you that were in the business, what was happening is we had a market boom because of all the lending practices that were going on. Anybody and everybody can get a loan, stated income. Their dogs could get a loan. Everybody could seem to get a loan. It was super easy. I bought a house during that time period. I said stated income, and the loan application was a joke. I mean, it was just so easy. And so there was such a confidence level in the lending market, in the financial market, that values would keep going up and these loans would be fine because they would have that loan to value ratio and be secured, and people would eventually be able to refi out. Also, what people were getting were adjustable rate mortgages, right? So they were getting 5-7 year ARMs, which they thought, okay, it's maybe interest only. I can afford this during that time period. And then what happened when that expired? Well, their payment jumped up in some cases over $1,000 a month or more. And they were just shell shocked and ended up losing their homes for having a short sell. But so we peaked in 2005, but then we saw the recession. You see how that drop off, it's a ski slope. All the way back down, hovering between 4 to 4.5 million. And then we started going back up after 2010. And then we've done nothing predominantly but go back up since then until 2023. So what happened? Well, we come out of COVID, we had almost a record year over the last at least 10 years in 21, where we crested that $6 million mark. Everybody did well in 21 if you were in the business. And then it went off the cliff because what? Stimulus money dried up. So people didn't have as much discretionary income. And then rates started dramatically increasing because the government stopped their quantitative easing and bond buying program. Therefore, they stopped manipulating the US Treasury bill or the 10-year bond market, and all of a sudden rates start going back up. Well, Feds start pushing rates up, right, to control inflation, because all that money flowing in the economy created a lot of inflation. And so they had to stop it. So the byproduct of that was interest rates, which were great at 3.5%, 4%, shot up and crested over 7%. And so what happens in that case? Higher interest rates, demand goes down, and now we're sitting at slightly above 4 million for last year. So pretty interesting. So just again, reflecting on the 2024 year, we did see the Feds finally start reducing. They did 3 consecutive rate cuts totaling 100 basis points or 1% in 2024. But what did we see with mortgage interest rates? So everybody was like, oh, thank goodness, finally the Feds are cooperating. We're going to see mortgage interest rates come down. But instead of mortgage interest rates coming down, they kind of stayed idle, right? And they actually ended up going back up because there is not a direct relationship between the Fed funds rate and mortgage interest rates. Why? Because the Fed funds rate controls short-term borrowing or lending. So your credit cards, car loans, home equity lines of credit, things like that is what the short-term rate or the funds rate really has more of a direct correlation to. Mortgage interest rates are more predominantly controlled by treasury bonds, the 10-year treasury bill, right? So that was not favorable at all during this time period. And plus the corrections that we saw in the mortgage interest rates were already anticipation of the first rate cuts coming up. So remember, right before the Feds did the first rate cut last year, that mortgage interest rates did come down before it even happened because the market responded. But after that, that adjustment was already there. So we didn't see anything happen after that, mainly because we'd already gotten the benefit of it. So we have to put that into perspective. But also the other thing to think about, again, when people are thinking, oh my goodness, mortgage interest rates are outrageous, I'm getting ripped off at a 6.7% rate, is the 50-year average of mortgage interest rates, and I ran this number again this morning, taking into account last year, is right at 8%. So 8% is the 50-year average. So if we're at a 6.7, how are we getting ripped off? Well, because I couldn't or didn't buy back in 2021. Well, I'm sorry. That was a fairy tale world. I mean, that's not reality, right? But here's the good thing that happened in 24, is people started finally getting used to it and understanding, hey, this is the new norm. These rates aren't as bad as we think they are. We still can buy a house. Maybe we can't buy a $500,000 home, but we can certainly buy a $400,000 home, and we're fine with that. And so as a result, we saw an actual increase in sales in most of the country, and here in the Central Valley, we averaged about 15% increase in sales volume by the end of last year. And we saw a 6.5% appreciation in the median price. So guess what? We did better than 23, even though it didn't maybe feel like it, we did. And I think a lot of that, again, is attributed to the fact that people are finally saying, okay, this is just going to be the new norm. I mean, we can't sit here and wait on the fence for 4% interest rates. They may not come back around anytime soon, if ever, right? The other thing that we dealt with last year, which if you guys worked, licensed and doing this thing last year, is this NAR settlement, right? The $418 million settlement that the National Association of Realtors had to pay to the class action lawsuits for colluding, antitrust, on commissions. I still am very vocal about it. And I'm still living and breathing, which is good. I haven't upset anybody too bad, but it was a money grab, guys. I mean, I'll say that. I don't care who asked me. That those attorneys figured out, took advantage of the Department of Justice investigation of NAR and said, hey, we may have something here. And they went out and created these lawsuits around it. And guess who won the settlement? Guess who got paid? It was the attorneys. The class action, I don't know exactly what they got paid, but I've heard super low numbers. Like it's not even worth what they got paid after you divided it amongst all those class sellers. The bottom line is the attorneys won and NAR is getting to pay $418 million. And then all basically the administration changes, the practice changes with forms and how we work with buyers and buyer rep agreements and you know, the mandatory nature of that, which became a part of the process. So for realtors, we have to follow these settlement changes, right? We don't have no choice. I mean, it's not prescribed by law. We talked about that, I think, on Tuesday. It's not a law, but as long as we're realtors, we have to follow and adhere to the lawsuit. Plus, Century 21 settled way ahead of time in the lawsuits because we, as a large company, were named in the lawsuit along with NAR. We were the first to settle, and thank goodness. We had one of the most reasonable payouts to get out of this thing, and we got our name out of the news, which was good, which I was not in favor of in the beginning, but then I understood this was the right thing to do just to get the heck out of it and move on with life. So I feel that our company rose to the occasion of embracing the changes and training and implementing on them to make you guys really the subject matter experts and knowledgeable in the market and really not have a flat tire, because a lot of companies out there just didn't do anything and they hoped their agents would figure it out. And many of the brokers that ran companies last year were clueless. Even after 3 months after the the August 17th changes, we were getting offers in with on old forms still, even in December, and not submitting the SPVB, not asking for commission. So here's my offer. I guess you don't have to pay me. I work for free. We were seeing all of it, guys. It was scary. And I was embarrassed to get calls from people I would have thought knew what was going on. And by the way, Mike, how does this work? And I'm going, where have you been? Been living in a cave somewhere in Siberia? I mean, this has been going on for 3-4 months already. So congratulations to you guys. You guys stepped up. You kept business going. It was painful a little bit in the beginning, but I think most of you are getting buyer rep agreements signed today. You know the dialogue, you know the talking points, and we're doing well with it. All right, so our company's strategic response, let's go through that real quick. So last year we did a lot of hiring and recruiting great agents. And as we always talk about, we don't just recruit anybody. We don't just hire anybody. We used to in the early days. I'll admit that, because we were trying to grow. We were hoping, we'd hire somebody, they'd do well, they'd fit into the company and our core values. But we stopped doing that. We hire mainly through referral and recommendation and personal experience. We hire strictly to our core values. And that's our 4 core values. They're on the walls here in the training room. If you can't meet these core values, we're not interested. I don't care if you do 100 deals a year. We're not interested. So we hired 65 new agents last year that met our core values. And that was amazing in a year that was kind of a struggle. Again, I mentioned we really unmatched settlement training. I didn't see any other company out there doing the amount of training and putting the resources in on the settlement practice. And particularly the zip forms training that, where the forms changed. And Kevin did a great job with that and keeping you guys updated weekly on that, and all the managers out there as well. The other thing, sometimes it's, in down markets, it's not only great to hire great people, but it's sometimes great to expand, right? So what do? We decided to go and open a Pismo Beach office on Price Street. So we do have a Pismo office, and we're looking to grow that market over there. And the timeliness of it was interesting, because within a couple months of securing that office, the largest Century 21 affiliate over there, Hometown, closed their doors in Pismo. So they kind of opened that market up for the C2 brand to continue there with us. And so it's a great thing. And we're very excited about growing the Central Coast along with our 4-county market here in the Central Valley. The other thing is just agent success. Again, you guys were relentless. You kept going. I'm proud to report 75% of our active agents in the company closed a transaction, outperforming the national average of 45%. So that's great. And it's may say, well, one transaction, but there were a lot of agents, even in our local markets, that didn't close anything last year. And so proud to say that most of you guys, when I say active, our active agents are ones that are under quantum, selling, member of the associations in the MLS. When they're non-active, or they're called limited function referral agents or referral agents, they're under my personal license. They're just agents that are licensed, but all they do is refer to you guys, and then they can get a referral, but they cannot practice or do any license activities. So the agents that were licensed, realtor members and active in the MLSs, 75% of our agents put up one or more deals, okay? We launched our Fine Homes and Estates division. Last year, we hired our director of Fine Homes and Estates. Many of you have met or seen Lena Marie Fisher, and she's been doing an amazing job assembling a team and really getting all the marketing collateral materials together for us to take advantage of what's going to continue to be a growing market segment. We're seeing a lot more movement in the luxury home sector just by virtue of people getting off the fence, rates gradually coming down, and then just, you know, a robust economy and people in those price points, you know, really investing and deciding to sell or go buy a vacation home somewhere. Look, we want to take part in that. We want to take advantage of that. And we feel there's a weakness in our 4-county market with luxury. We don't feel a lot of other brokerages focus too much on it. There are certainly good luxury agents out there, but we don't feel companies really focus on it. So we want to take advantage of it and we want to focus on it. And I too want to be like the guy on Selling Sunset and deal with luxury homes. It seems exciting, right? The numbers are bigger and, you know, I already got his look. We have the same hairline, right? I'm just about a foot taller, but other than that, I think it's a great market to be in. And I think we're going to continue to see movement in those high-end, particularly gated communities and things like that this year. And last, we just continue to invest in relevant technology. We cleaned house, got rid of stuff you guys weren't using, we weren't using. Double down on Moxkin Gauge. We're revamping Bold Trail, and we're always looking for opportunities to bring value to you guys. And we're really hyper focused on AI right now, and I'll touch on that a little bit here in a second more. So. All right, so moving on to the next slide, our 2025 market forecast. So I got my crystal ball from Walmart and I'm looking at it right now. And you guys believe that? Nobody's laughing here in the room. Hopefully somebody's laughing out there. My jokes are better than Michael's. I mean, right? I mean, they're not dad jokes, but it is a crystal ball. I mean, last year was just the way it ended. It was very unpredictable, right? But let's take a look here. So this is a slide that CAR put out. So sales are starting to bounce back, but have been a little volatile each month in terms of pendings. But here's the good news. So if we look at 2024 in the yellow there, you know, that's where it was projected. They don't have the final numbers for 2024. CAR hasn't come up with the final numbers. So that was a projected number right there. But they're projecting about a 10% increase. So really going from about 270,000 sales in California up to 304,400. That's, you know, that's a pretty good jump. And that gets us back above 24 and 23. So not as good as 22, but hey, I mean, we'll take the increase, right? So that's a good signal. And then also the median price keeps going up. That's a mixed bag. Is that good or bad? I mean, right there, we're at 909,000 projected for 2025. And, you know, we're coming off of about an 870,000 or 67,000 average from last year. That's a problem in particularly in parts of California. So when we talk about housing affordability index, and that's the percentage of population in a given geographical area that can afford to buy a median price home, you know, the state of California is really struggling at about 14%. Good news is our area here, we're still around 30 to 32% in our 4-county market. So we're better, which makes us a lot more desirable in the state, right? But that number continuing to go up is not necessarily good in higher price point markets, but it is what it is, and it's a testament to the fact that the market's not crashing, we're not subsiding, we're not going back. You know, buyers that are sitting around waiting for the next crash, you know, they may be waiting for a long, long time. And at the end of the day, there's just no sign of going backwards on that. So let's go to here. So 2025 local market forecast, sales growth projected in our 4-county market. So what I did is I took stats from Fresno, Tulare, Kings, and Kern counties and blended our 4-county market aggregate. So this is mainly single family residential sales. So it doesn't include commercial or industrial or anything like that, or multifamily. But so sales growth on SFR, we're looking at the company's projecting about a 10.5% increase, which would be approaching about 18,000 units in the 4-county market. So that's good. I mean, that's really strong. I think there's a reasonable chance that we're going to do more than that, just based on how this quarter's opening so far and what our pendings are looking like as a company. I feel that that may be even better. What do we expect on appreciation? Here's a bit of good news. Appreciation, I mean, has been going up dramatically at an 8 to 10% clip since COVID, but look, we're only projecting about a 4.6% increase year over year to a blended average of about 425,000. And that's a good thing. I think appreciation slowing down to preserve affordability and let wages and the economy catch up is a good thing. Just as long as we don't go backwards. So I like that number, and I think that's going to hold true somewhere right around there, maybe 5% in our relative markets is a good thing. What about interest rates? So interest rates, easy because they're in a 6% range. It's easy to say they'll be averaging in the 6% range, which I think it will most of the year, but I'll share one of my bold predictions with you about this a little later. So what about Central Valley migration? And we're not talking about migrant workers, so don't confuse that, but just general migration from other areas in the state and even out of state. What can we expect on that? And really what we have to look at is the fact that we are 4 out of the 6 most affordable counties to live in the state of California. Out of all the counties, we're one of the 4 of the 6. So, and then you take that factor and look at the quality of life we have in our counties, our communities. I mean, whether it's Visalia, Bakersfield, Fresno, Hanford, Lemoore area, these are nice cities with a lot of opportunity, great school systems, and just a lot going on, a lot of infrastructure. And, it's not a bad place. Yeah, we've got hot weather during the summer. We've got some air quality issues, but everywhere has issues. I mean, you think LA would have been a paradise to live in here a year ago, maybe, but what happened there? I mean, got to deal with fires, right? So it wasn't so much a paradise anymore, which we're going to see some of that migration as people cash out on insurance claims and decide to get the heck out of Dodge because they just can't easily insure a house in the hills over there anymore. They'll be coming to look at where they get bang for their buck. Well, this is this area, right? So we will continue to see Central Valley migration this year that will benefit you guys. So as you think about marketing yourself and your business, who would I be talking to? I think I would be looking at, whether it's digital or otherwise, out of area buyers or people you can hook up with that have a home to sell out of area that, hey, we can help you sell your home. Either I can help you or through our referral network, and let's get you over here and get some bang for your buck. Think about that in your marketing. Think about expanding your market beyond your town, your county, the Central Valley, and let's be that conduit for drawing that migration in, because somebody is going to represent these people. Why not you? Why not us? I mean, we're all over the place. They already recognize who we are. We're not an unknown. We're not a small local independent that nobody knows about. We're a known entity. So think about that in the context of your digital marketing and maybe your social media marketing. All right, so here is the overall housing market outlook, just in a nice graph for Fresno, Tulare, Kings, and Kern counties. So single family home sales, look at 2023, we're only at about 14,400, jumped up to 16,076 in 24, and then ended up, or we're thinking it's going to be right under 18,000 in 25. So 23, if you look at the year-to-year change, was 12.7% down compared to 22. Ouch, right? I don't like those negatives, especially double-digit negative numbers. Numbers people like me that just gives you heartburn, right? But then we go to 24, and we had about 11% jump overall year over year in our 4-county market, and we're projecting conservatively another 10.5% jump this year. Again, I want to be conservative, because we budget around these numbers as a company, And we didn't want to budget to some optimistic 15-20% number. We said, okay, we feel pretty good about 10%, so let's budget to that. So I think that's a minimum. So what about the median price? 378 in 23 blended average, 406 in 24, and up to 425,000 in 25. And so at the end of the day, yeah, I mean, it's going to keep going up. And there's that housing affordability index I talked about earlier, was sitting at 31% blended average in 23, dropped down a point last year, and it's projected to be almost flat this year between wage increase and then appreciation. All right. And then what about that mortgage rate? Well, we think 6s most of this year, but possibly a 5.9, and I'll talk more about that. So why consumers should act now? So why are we waiting? What's the competitive narrative? What can we tell people to not sit on the fence, particularly buyers? Why are we sitting on the fence? Well, number one, you know, we really, if we're sitting around waiting for interest rates to drop, what's happening during that time period? Well, values are going up, demand's going up. You know, inventory's coming on, so more sales, more demand, prices will push up. Simple economics, right? So why are we sitting out on the appreciation game, waiting to save 1/4, 0.5%? It makes no rational sense, but yet we still have people doing it for some reason. The other thing is just, you know, leveraging the equity. You know, with sellers, if you bought in the last 2 or more years, you're sitting on equity right now. In some cases, 20, 30, 40,000 or more just over the last couple of years. And we could take that equity and move it, you know, tax-free in another home, right? So what are we waiting for? Why are we waiting to do that just to save 0.5 point or whatever on an interest rate? So it's just a scary mentality. But there's also this thing called refinancing, right? A refi. We can refinance loans. We're not locked in for life. I think when consumers hear about a 30-year fixed loan, they think it's fixed for 30 years and they can never do anything about it, right? They think it's like carved in stone, like the 10 Commandments, and I'm stuck forever. But no. You can refi. You know, there's a good time to refi. Lenders will work with you on it. We don't want to refi just to save 1/4 point. The fees don't justify it, but maybe when you get to a full point savings, that's the magic number. That's my rule of thumb on any type of real estate refi I've ever done. I've waited for at least a point difference before I've done it. And at the end of the day, competitive advantage is less people shopping at current rates right now. So we haven't had the onslaught of the spring selling season and all the buyers coming into the market. You know, right now, if you're a buyer, you have less competition for homes. And if you're a seller, you have less listing competition. So this creates a sense of urgency of why not to wait. So I would like somebody like a seller or buyer to tell me a logical reason that's plausible why I should wait at all if I have a need or desire to buy or sell. Right? I mean, there's just no reason at the end of the day. So here's a nice little graph I put together. I did this all myself. I worked on it for 5 hours. No, ChatGPT did it for me in literally like 5 minutes because I gave them these numbers that created, on this example, I want to show what would happen under this scenario. So I'm a buyer buying now at 400,000 at a 6 3/4 rate, 6.75%, versus if I waited until July for the number to get down 1/4 point. I think July had to be below 6.5, but I'm giving you a relative example here. And the value went from 400 to 420K because the spring and summer selling season pushed values up. So am I going to really save money or not is the question. And the answer is absolutely not. Your payment would increase $60 a month by waiting from between now and July, just to try to save a little bit of an interest rate, because appreciation has far more impact on percentage interest rates, right? So, and this is based on homes rising about 5% this year on average. So over 30 years, waiting could cost tens of thousands of dollars in additional payment. It's better to act today. You know, there's no reason to wait. And bottom line is there will be plenty of opportunity to refinance, you know, probably later this year where it will make sense. All right. So 5 bold predictions from last year. Here's my report card. Did I get them right or wrong? So I hate being wrong, right? So So I did predict, along with many others, that prop tech and artificial intelligence or AI will play a much bigger role in real estate transactions. And I will say, I'm going to give myself credit for a hit. I don't know that it played a huge active role yet, but I can tell you every broker summit, leadership conference event I went to last year, 80% of the content was AI. You know, new companies emerging, talking about their solutions and just the concept in general and the use of ChatGPT and Gemini and some of the other sources out there for how it can enhance your business. It's whether you like it or not, it's here to stay, it's going to get stronger, it's going to be more relevant. And remember, I said, and the quote's similar out there, many people have used it. I mean, you know, you guys as real estate agents will not be replaced by artificial intelligence anytime soon, because what does AI lack right now? AI lacks empathy, right? AI cannot connect with people. It can act like it connects. It does a good job of acting, but it really can't. And people don't want to buy from machines, right? They just don't. But, you know, people want to buy people and they want to know people care. But, you know, agents that aren't using AI are going to get replaced. That's what's going to happen. So if you're an agent refusing to use anything AI and make your client's life and the transactional experience more seamless and efficient, you're going to miss the boat and you're going to be pushed out eventually. So I hit that one. So we will see mortgage interest rates in the upper 5% range by Q4 24. I missed this dramatically. This was like an air ball. I was like 10 feet from the rim on this one, right? I mean, I should have been benched after that. So I missed. So they ended up at 6.7% the end of December. Nowhere near 5. But I've put too much weight into the Feds starting their reduction on the funds rate, and it had no effect virtually. So hey, I mean, I was along with many others optimistic about 5s, but did not happen. Number 3, dramatic shift to more experiential rather than transactional service models. So again, this means just the old algorithm of listing and MLS and getting offers and putting it in the system, and you know, many agents disappearing and turning it over to the TC, and you know that I felt that in a struggling market where really sellers are lost, buyers are lost, everybody's lost. What's going to happen? Everyone's scared about what's happening with rates and affordability, and at the end of the day, I feel that the agents that succeeded and the companies that succeeded last year are the ones that provided a better experience and more seamless for the client. So I'm going to give myself a hit on that one. And we saw a lot of companies fold last year that weren't providing a strong experience for their clients. We did. They just went away. They just became non-relevant and not trusted. What's beautiful is in a market like we've seen, you know, people seek what they know. They seek what they trust. So they sought a 50+ year trusted brand, which is Century 21. So which is why we continue to do so well throughout the market last year. All right, number 4, the rise of rural markets seeking more bang for the buck. So again, that's the influx of people coming in from metropolitan areas to basically either retire or relocate, or maybe they're in a remote telecommuting environment where they can work from home. So yeah, I felt I missed this because it just didn't happen at the level I thought it would last year. We just didn't see the numbers last year. I think you're going to see more of that this year, so stay tuned. So last is just the resurgence of the full branded brokerage. Again, people seeking value, a higher value proposition, getting away from a little bit from the online and virtual environment and the iBuyer scenarios, things like that. I felt that I hit that not at the level I thought. Obviously, devil's advocate could say, well, seems like real brokerage is doing well, but real brokerage is a hybrid though. Guys, be careful with that. I mean, they've gone out and recruited teams and gotten brokerages to white label under them that are still carrying overhead and pretending to be real full service brokerages, which is fine. I mean, it's a fine value proposition. There's great people doing it. I think their president's brilliant, but what we did see take a huge hit was EXP. EXP had a lot of outflux of agents and they struggled financially and they're just not doing well. I think that really is a testament that the value wasn't there. And we as a company recruited, I wouldn't say a lot, but quite a few EXP agents last year. So how does that work? You know, I mean, how do we, because those agents recognize I need that value. It will help me do more business and be more profitable. I need live people face to face to talk to. I need to be able to pick up a phone and get a hold of somebody immediately. And I just wasn't getting that with this self-service brokerage, which is what I'll call it, the self-service brokerage. So overall, I got 3 out of 5. That's a D. I think that's 60%, right? It's horrible. I haven't gotten D's since high school. It's like my high school performance. I was having PTSD when I saw that, but hopefully I do better this year. But honestly, getting a few right's not bad. So let's talk about 5 bold predictions for the real estate market this year. And some of you read in the report, but I'll spoiler alert, I do have a 6th one today that nobody's seen. That's a bonus one that I'll talk about. All right. So number 1, come on, curtains, let's go. All right, 5 bold predictions for 2025 real estate market. Number 1, mortgage rates will eventually bottom out at 5.9. We'll see a 5 at some point by the end of the year. When do I predict that? By the 4th quarter. And based on how everything's lining up and what's happening even today with the bonds market, which I'll talk about here in a second, is I think that we will see a 5.9. Now, I was wrong last year, but hopefully I'm right this year. And I think there's a lot of factors lining up to that. But are we going to get down into the mid to low 5s? No, I don't think so. I think we'll just get right under that 6 mark. But look, let's be honest, even if we're right at 6 flat, we're going to be much, much busier this year than last, because we never even got down to 6 flat last year, right? Not even close. I think we got right under 6.5 briefly, but then just went right back up. So that's a good thing if we can get that to happen. And when we think about the context of interest rates and that whole equilibrium where, what's good for everybody, and, banks, as I mentioned before, and financial institutions and, backers, they don't make money at 3 to 4% interest rates. You just don't. It's a loss leader. You're losing money, and you're hoping, the feds will give you money to sustain that. But the reality is, at that 5 to 6% range, the banks make money, and it's still a fair interest rate because it's below the 50-year average of 8%. So the reality is, I think it's a good place to be in that 5 to 6% range. I think it's a win-win for everybody, and it keeps the economy stable and the financial market stable. Next one is there's a boom in multi-generational housing solutions. So what do we really mean by that? So, well, the bottom line is people are looking to leverage. They're looking to find more cost-effective ways, particularly in the higher cost of living areas in California. And they're looking for multiple family living solutions. So basically, you've seen it in the metropolitan areas, right? You've seen different family members, parents, kids, brothers, sisters, all going in on a house together. And the house is being designed or built in such a way where you have 2 master bedrooms, or you have an attached ADU, or maybe there's a garage conversion, or you have an ADU in the backyard. But this is a trend that will carry over even over here. It will carry on even over here. And there's different reasons why, because number 1, we have a housing shortage all across California, including here. We just don't have enough housing, whether it's for rent or to own. And so the state's been cognizant of the lack of housing and the new home starts, the new home construction starts. And so they've enacted some legislation behind that to help kind of kickstart that into hopefully creating more multi-generational housing solutions. And number 1 was a couple years ago, they passed a bill, SB 897, which made ADUs jurisdictions pretty much automatically approve ADUs for properties as long as the lot size was enough and the setbacks were there. But you can't be told no, you can't add an ADU to your own property now, which is good. The surprising thing is a lot of people aren't taking advantage, whether they have the room in their backyard or otherwise, or they have a piece of their house like a garage they can convert. A lot of people aren't taking advantage, and you have many of the municipalities, for instance, the city of Visalia, that have pre-approved ADU plans you can go down and get for free and just pay for the permits. So you go down, you get the plans, you have to pay an engineer and architect to do all of that, and you can build an ADU. They'll approve that plan on the spot. You just pay your fees and you can build. So that was one, and the other one, some of you know about, which we've talked about, is SB9 legislation, is where you can take an existing lot and split it, and then add another 2 units onto the split lot, as long as there's room, right? And that's creating more housing, because you can take a single family and maybe have an ADU, so you already have 2 units, and you can add another 2 single family and an ADU onto that. So now you've created, more solutions there, and you can do it as an investment or just to create more housing for your family, either one. So I think that's going to continue to catch on. There are companies out there that they've talked to us, they're probably talking to you about, you guys that really going out and pushing ADUs opportunities and SB9 opportunities with your existing and past clients, and create business for everybody and opportunities to add more housing. So I think that that's going to continue at a much, much greater level in 2025. Okay. So the rise of fractional ownership models, this one's a little bit out there, and it's just about, offering a way for investors or buyers to enter into the real estate market without a complete financial commitment. It's just group or investing, if you will. It's not like REIT investing, real estate investment trust. You're actually buying, you're an actually owner deeded on the property, but you're going in with multiple people. Just to make it easier to own investments. I've done, not a lot, but I've been doing that myself. I've been buying multifamily properties on, with, multiple group partners, to where, I may be in on a 15–20% interest. But there's a high rate of return, because the money I'm lending, I'm getting paid an interest rate on, and then I have a fractional interest. So when the property goes to sell down the road, I'll get that equity at that percentage on top of what I got paid on the note. So it's interesting, and you're going to see more of this on a smaller scale, meaning your big hedge funds out there, namely we've heard the infamous BlackRock out there buying up, thousands and tens of thousands of homes. These are smaller groups of people, more at a local level, that will form a partnership or a syndicate to basically go buy properties, right? And to build their wealth. There's some platforms out there like Picasso and Arrived Homes that do allow multiple investors to go onto that platform and do that. And it organizes everything for you. And you won't know these people, but everyone's qualified on there. They've already done background financial checks. You're not getting in with anybody that's bad news. So check out Picasso and Arrived Homes if you're interested in those opportunities. And it's just a great cost-effective way to get into homes, easier without having a huge 20, 30, 40% down payment. And great way for you guys to get into it now, rather than have to sit it out until you get that maybe 20% down payment saved up. So keep an eye on that. I like it. I think it's better than REITs. Anybody ever invested in REITs? The best I've ever seen or dealt with is about 7% return on a fractional ownership over time through appreciation and just basically value add. And if you're getting paid on your portion of that note, you're going to do a lot better. Like the last one I did, I invested in a 10-plex in Detroit, and I'm going to make and we're going to get ready to sell it this year because we've done improvements. It was a flip, a little bit longer term flip project. I'll end up making 18% on my cash. I mean, why be in a REIT or the stock market when you can do that, right? All right, so unskilled agents will leave the market in droves. Whatever droves. Does anybody know what droves means? I think that means a lot, right? But here's why I think that, and I kind of poached this from Brian Buffini. Anybody watch Brian Buffini's bold predictions for 2025? So Brian Buffini predicts that over 30% of the realtors by the end of this year will have gotten out of the business. 30%, almost a third. I don't know. I mean, I don't know if it'll be that much, but I know it's going to be more than average. And here's why. Because the dynamics of the market's changing. You saw how the unit volume nationwide has gone way down. There's less homes to sell, right? And less homes to sell means the part-time agents, the agents that aren't committed, the agents that try to do a couple deals a year, whatever falls in their lap, it's just not justifiable for them to pay member dues and stay in the business and MLS dues. You guys, it's an investment to be in business and real estate. It's one of the easiest investments or smallest investments to open a business I've ever seen, but it's still an investment. So a lot of these people are just going to go referral, right? There's like, why am I going to pay these fees? Let me just go referral and get a piece of things, and I'll kick it to people that are active. So I do see that. And the other thing that I think is really scaring agents away this year is just coming out of the NAR settlement changes last year. A lot of them don't get it. They're scared. They don't understand it. They don't want to understand it. They don't want to learn, and they don't want to be skilled. They don't want to know things. They just want to simply write a contract, hand it to the TC, and check on it in 30 days. But that's the agent that's getting pushed out. It's a form of Darwinism, right? And to me, it's natural selection in these evolving, changing markets that unskilled agents go away. I mean, we saw it during the Great Recession when the volume dropped off. Those agents all got out of the business, and I think that was literally a 30% exodus back then. So I think 30% is possible, but you know, I mean, at least maybe 20% to 30%. But I think the good news for you guys is you're staying in it, and at the end of the day, that means more activity for you that are serious about it. So that's a good thing. It's a natural thing. It does need to happen, and we'll see if we hit this one at the end of this year. All right, the great housing inventory surge of 2025. So this is interesting. A lot of people are like, well, what do you mean by inventory? Well, I mean, we're not getting any inventory, but it really, I think we're at a turning point of housing supply for a couple reasons. So I think you're finally having a lot of sellers rationalize the fact that I can't wait any longer for rates to come down to buy my replacement home. Therefore, I'll take advantage of my equity now and list. I think you'll see baby boomers downsizing and going to retirement homes. We're just at that point. We're seeing a lot of that movement right now, and they just need to sell. And the big one is the institutional investors are just going to simply get out of the market. So your big institutional investors that aren't seeing the appreciation rate that they liked. So their investments aren't performing at what they were before, and then they're having to manage properties. They have higher vacancy rates in some areas. They're looking at it like, hey, we can take that money and put it somewhere now and get much bigger return. So if investors aren't out buying up inventory and putting renters in them, then that means more opportunities for realtors to sell those homes. And you know, I think that in certain regions you'll see an influx of listings. You know, like ours here, just by virtue of the fact that, you know, we got a lot of movement in and out of the valley, and you know, people are retiring and going to out of state, and they're going to you know, maybe the coast or whatever their next plan is. So I think we'll see that. And so I think a lot of those factors are lining up to where we're going to see a lot more inventory. If you look at the numbers now, we are up year over year on just our existing, you know, standing inventory. But I think we're going to be surprised how much more inventory we're going to be working with this year. Companies started out great this quarter so far on listings. We've just done really, really well. So that's a good sign. It's kind of validating that. So I think that's it, but I do have one bonus one. Drum roll. All right, so end of the iBuyer era. So a shift back to agent-driven real estate. So most of you have heard this term iBuyer, but a lot of us are going, what the heck's an iBuyer? Is it like some robot that goes around buying houses, or what is it? Kind of, but it's basically a company that uses AI or algorithms and automated valuation models, AVMs, to make instant cash offers on homes, and just quick, easy, no fees, no realtor fees. And what their aim is to underbuy by a certain percentage and resell as quickly as possible to get a gain. But rising interest rates made borrowing more expensive for these iBuyer organizations. So it's really squeezing them out of that market and not making as much sense anymore. And you know, declining home price appreciation means iBuyers can no longer rely on rapid value growth to flip houses. So rather than 8 to 10%, a 4 to 5 is not enough for them, because they're going to be stuck much longer with the home. Massive losses in 2023, 22, 23. Zillow offers, they got out of iBuying. Remember, Zillow was all about iBuying a couple years ago, and they were going to conquer the world with iBuying, and you know, they're pretty much done. And they just lost their shirt in that program. It just didn't work for them. Open Door lost over $1 billion in 2023 alone, and has been forced to slow its acquisitions down by quite a bit. OfferPad has struggled to maintain. I mean, they're shrinking big time, and they're almost, I remember they were advertising a lot. I don't see any advertisements anymore. And so basically market conditions are really lining up to favor retail buyers. And so That's really good news because again, that puts more inventory in our hands to control and move when we get rid of these iBuyer programs, which, you know, I just was never really in favor of. I think that I get what they're trying to do and how they're trying to make money, but I think it's better to be done by us, the professionals. So, all right, closing thoughts. Do I have any closing thoughts? Sure, I do. Time to get off the fence, right? For everybody. Sellers get off the fence, buyers get off the fence, agents get off the fence. Let's stop playing defense and get off onto offense or off the fence, you know, kind of pun intended. But seriously, how many of you felt like you're in a defensive mode last year? I mean, just trying to survive and weather the storm. And I think we fell into that trap as a company at times, albeit we stayed aggressive in certain areas. But you know, the reason for sellers are obvious. Just some reminders, you guys know them. Home values have held and are rising. They have equity. They bought 2 or more years ago. Unless they've done some cash out refis or HELOCs, they should have plenty of equity to move into the new home. Tax-free transfer period on their net proceeds up to $250 per person or $500,000 per couple. Like, you know, you can basically take that equity and roll it into a replacement home as long as you're going to live in it, tax-free. Why wouldn't you want to do that? That's amazing, right? Inventory is still low, so that sellers that are looking to put it on overall won't have the same competition today that they will probably sitting in May or June this year. And we're not quite yet in a market frenzy. I hope we get a little bit of a spring, summer frenzy. But so again, there's less competition for that seller to go out and find a replacement home right now. And for buyers, just more affordability now versus even 6 months down the road. I mean, it's only going to get more expensive. The price of real estate's going up. Real estate is on sale. It's going up, right? It's going up. And there is a big opportunity cost for waiting. I just showed you one of them. Is like you could end up paying more money on a monthly payment by waiting, just trying to save a little bit of percentage on the interest rate. Take advantage of the affordability now, particularly since there's less competition on the market. And hey, if you need help with rate buy downs or other things, because you're not quite as liquid right now, there's a lot of down payment assistance programs out there for buyers to take advantage of. They just need to get with one of our lender partners or whoever they choose to determine what their options are. Even if the buyer's saying, I don't want to buy now, I need to wait, get them with the lender now. Because then you can map out a game plan. And I've seen many buyers over the years that have been shocked what they qualified for and what they could do once they knew how it worked. Because they thought they had no ability to buy and that they had to have all this money saved up. And they even thought their credit was bad in some cases. And they find out, no, I'm ready to buy. So let's get them in front of lenders. All right. Opportunities in the 225 market. We're back in getting more towards this traditional market, seasonality, more traditional. So it's not as weird anymore, which is good. Rates will continue to decrease at a healthy pace, not a dramatic fall off the cliff pace, but a healthy pace. I like this one. I used it last year. Amateurs will fail and professionals will prevail. Don't be one of the 30,000 or 30% leaving the market this year. Be a professional and you're going to prevail. Our Central Valley counties will be a magnet for out of area buyers. Sellers who bought 2+ years ago have a great equity and it's time to sell and move. Buyers will have more choices and renewed negotiating buying power as we move forward and more inventory starts to come on. So look, it's a great opportunity. Again, I'll reemphasize to work with certain niche segments. A lot of first-time home buyers. The millennial group will be the biggest buying group demographically this year versus every other generation, and a lot of those are first-time home buyers. Become an expert with those people. Convert renters to owners. Big opportunity. Renters to owners. Hey, look, renters around here on a single-family house, they're already paying a mortgage. Actually, they're paying more than a mortgage, or else that landlord wouldn't be making money, right? So the bottom line is, why don't we convert them? And then just investors in general. Investors are going nuts right now. A lot of aging investors. The company took great advantage last year and helped a lot of aging investors liquidate their portfolios. We did a ton of multifamily portfolio liquidation last year. We should be representing those future investors and on the purchasing side of that. Those who control the narrative will control the outcome. I said that earlier. And agents with the right mindset, skill set, work ethic, value prop, outstanding support, great branding, and marketing will grow their business in 2025. All those things. All right. All right. So that ends the presentation. I will open up for questions here, but let me remind you on the Real Producers Awards. I think that ends on the 14th is the last time you can go and vote. And the company has a total of 6 people nominated for those awards, and the ceremony takes place on March 27th up in Fresno. I've been nominated for Broker of the Year. Sandra, our Fresno office manager, has been nominated Leader of the Year. Our very own Louis D. Mota here in Visalia, Leader of the Year. And Carmen Jimenez Phillips, also in Fresno, and the current Fresno Association President, Leader of the Year. And Nicole Altheim, Rising Star of the Year. She's in our Fresno office. And then Adam Roman, our Porterville office manager, as a team builder. So please help us if you haven't gone on and vote. There's a QR code. You can snap it now. You can go online and help us out. Let's get some winners here. And these are very, very deserving people. All right, so I will open it up for questions if there's any online, or if anyone wants to unmute. If somebody in Visalia Training Center asks a question, I'll repeat the question so people on Zoom can hear it. So what do we got, Kevin?
I don't have a
Zoom
question, but
Okay.
I wouldn't give you a D grade. I think,
Thank you.
I worked with, an agent, this year we closed, and he's been here a couple of times for the training sessions and everything, because he doesn't get anything elsewhere.
Right.
I think it is our job to educate people, because social media and news do not help us, because they're very, very negative. Every time I turn on a channel, it's either really, really bad, and it doesn't help, right?
Right.
And it doesn't move the confidence up for buyers or sellers, because it's uncertain.
Right.
What kind of future there is, especially now, right?
Right.
But how would you change that if
Yeah.
if we don't have that much of a presence to change the narrative for a whole county or community or
Yeah.
even state, right?
Right. Yeah.
So how do you do that when
Yeah.
you're up against that?
So the question from Art here in Visalia is that there's a lot of fake news, skewed news, a lot of media sources, whether it's TV networks, newspapers, online news, social media, are really painting a doom and gloom scenario on the economy and or real estate. And in some cases, creating a situation where they feel that real estate's a bad investment or the market may crash. And how do we get through that noise as realtors to battle that when it's on such a broad scale? How can we change public sentiment to really sway to the truth and control that narrative? And it starts one person at a time. So where I would start that discussion is with our past clients or center of influence and anybody that we come across that's asking about real estate. And it's just grassroots, meaning that we're not going to be able to launch some huge campaign and sway public sentiment by spending some advertising dollars. That's just not reality. But where reality is starting at the one person at a time level. And I love going out and just wearing like my Century 21 pin, which I have on my lapel here. And this is recognizable. C21 crest is people, Century 21. It's amazing how recognizable. And they start asking about these things with fake news, and I will sit there and correct it. I just did this in my chiropractor's office a couple weeks ago and talking about what's really going on and where rates are heading. So you guys, how you control the narrative is through your center of influence. I'd be picking up the phone, calling them and updating them on, just take an excerpt of this presentation that might be relevant to your past client or center of influence base, and just call them and give them an update. Hey, our company reports out. I want to share some information with you. Let me share this 1 or 2 things with you, why it's a great time to buy or sell. Do you have any other questions? That's how we start. We start one person at a time. All right. Any other questions? Really? I did such a great job, or they just got tired of hearing me? They fell asleep?
Now we got 20 people online,
Yeah.
but
Any other questions in Visalia Training Center on any of the data? I know it's a little overwhelming and quick, but hopefully it was presented in easy to understand fashion. But I think I think the signs are good this year. Rates are coming down, guys. The bond market is picking up. It's becoming a better investment. We've lost over 3,300 points over the last 30 days in the Dow. So what you're seeing on the stock market right now, and so those of you who have retirement accounts, and you're freaking out a little bit like I am. Thank goodness I have most of my investments in real estate. But you're seeing what could be a market adjustment because it's just risen so quickly over the last year. And an adjustment's healthy because generally, but not always, but generally when you see a stock market adjustment, you see the bonds, 10-year treasury bond market become more favorable and more buying, and that will push rates, the yields down and push rates down. So I think if you see rates sliding down, which you have over the last few weeks, it's been more of a direct cause of the stock market decreasing and what I call some panic selling going on, which is really an adjustment. A true adjustment in the stock market is 10% or more decrease over where it peaked. It peaked almost, the Dow peaked at almost 45,000. We're at 42 and change today. We're not quite there, but if we keep on this downward slide and drop another 1,000 points on the Dow, I would consider that a correction. But again, I feel that should be favorable to the bonds market, and that could push rates down pretty quickly, even to the low sixes here over the next 30, 60 days. So I think it needed to happen. I think it needs to happen, even though I'm taking a hit like many of you on your investments, stock investments, but it's okay because real estate will keep going up. All right, any other questions? Ready for lunch? All right, thank you guys. Have a great day. Appreciate you.
On the interest rate, but interest rate's tax deductible.
I know, and there's so many advantages to owning a home investment wise, beyond just being a place where you live, raise your family. It should be considered only an investment. I mean, it should be considered your home, but as long as we have mortgage interest reduction, tax, appreciation, I mean, why?
You're making money on it, the government's giving you.
Why, I know transitionary wise, it makes sense to rent. I've rented in my adult life a couple times because I was in a transition. But just owning, I've had my house I'm in now since 2017. I literally have almost 300,000 equity in it since I bought it. I bought it very well. I bought it off market, but I never thought I'd have that much equity 7 years later. Never thought in a million years I'd have that much equity. So it's like, thank you.